Alright, everyone, let's get this going, let's get the news flowing, and let's get those portfolios growing. We've got a stellar show for you tonight covering the CPI report, global events, and an analysis of the market. And now, onto the Food Network, the CPI release. The Federal Reserve must have been really busy in the kitchen last month trying not to scare away the bulls with all of this banking crisis. The CPI report came in slightly below expectations, with most analysts estimating headline CPI to be around 5.0 to 5.1%. The actual number showed headline inflation coming in at 4.9%. So essentially, we saw a year-over-year drop of 0.1% in inflation. And month-over-month, we saw an increase, yes, an increase of 0.4%. What is being celebrated out here? Are these people writing the headlines saying that the CPI report was amazing, even reading the same reports as us? Now, looking at the Fed's favorite indicator, the core CPI, this was also expected to come in at 0.4% month over month, and it came in right on target at plus 0.4% month over month, with a year-over-year rate of 5.5%. This indicator, the Fed has repeatedly said they use to gauge the Federal Reserve funds rate. Where is the progress? We have been at core inflation of 5.5% since February of 2023. There is no progress here. Taking a closer look at the CPI, we can see energy being down 5.1% year over year, services, excluding housing, up 6.8%, food up 7.7%, shelter up 8.1%. Thankfully, the things that are getting more expensive aren't your basic necessities, it's just housing, food, and services, but hey, at least gas prices went down. So how reliable are these drops in energy anyway? We have a war in Ukraine, we have coups in Northern Africa, we have OPEC, specifically Saudi Arabia, continuing to do whatever the hell they want with crude draws in order to ensure higher prices. Now, this might just be my lizard brain, but whenever I'm driving around and see gas prices drop from $4 to $3 and then hold at $3 for a long period of time, I don't normally expect gas prices to continue dropping to the $2 range. Either that, or it could be the realization that despite continued talks of the SPR being refilled by the Biden administration, it's still draining it. The lunacy has to end soon. We only have so much reserves in the SPR. This is bullish for oil in the short term, but with recession fears on the horizon, I wouldn't do anything long term with oil. So, the big question here, how do we hedge against inflation in this crazy market? And how do we prevent our portfolios from collapsing when we have all of these wars and uncertainty in the market around us? This man thinks he has the answer. Take a look.
More than 50%. I would say on the magnitude of 70 to 90% of the dollar's purchasing power is going to be lost. So if the dollar were to lose 90% of its purchasing power, the price of gold would go up tenfold, which would put it at 20,000, right?
That's right, ladies and gentlemen. Peter Schiff, a man who has predicted 40 of the last 2 recessions, is again calling for a crisis that will be worse than 2008. Gold, gold, gold. Peter Schiff is always touting. 20% of your portfolio should be in gold. But what is he in? According to his 13F filing, basically data that he has to release quarterly as a hedge fund, he doesn't hold any physical gold. He holds gold and silver miners. So let's take a deeper look at this. If gold was the best thing to hold in your portfolio, why would gold and silver miners immediately liquidate what they mined? Why not wait a year, make an extra 20% in profits? That'd be like getting Bitcoin miners in 2010 and selling their Bitcoin immediately because there may be more profit made right now rather than in the future. If Schiff were correct, that means Every gold and silver miner in the history of ever has been wrong about immediately liquidating their gold and silver. So why does he push gold so much? Oh, he owns a gold and silver dealer, meaning he is selling gold at a premium to mom and pops that are trying to protect their hard-earned income for a 10% premium to these mom and pops. So how is this wild bears portfolio performing? Well, over the last 10 years, the S&P 500 has returned 160%. Well, yes, all of Peter Schiff's funds have returned a -% before fees. This is at a time where we have been in the biggest bull market in the last 100 years. And in the last few years, it has been impossible to not make money by buying stocks. A literal ape, yes, a literal ape could throw a dart at a board and have picked a winning stock, and he couldn't. Moving on to the markets. Why is the bond market so bullish on rate cuts when the Fed has continually reiterated the fact that they haven't even spoke about rate cuts in 2023, nor are their dot plots reflecting this? And what if we did rate cut? We would see a resurgence in inflation like we have never seen before. We would give Michael Burry yet another chance to dunk on the bulls by shorting the US economy. If we look at what the big players are doing right now, they're cycling back into cash and taking their 5% yields on bonds and money market accounts. Both Warren Buffett and Michael Burry, even Michael fucking Burry, or as we like to call him, Dr. Doom, Gloom, Death, and Destruction, isn't predicting intense pain in a recession is coming right now. He is predicting that the pain comes from the Federal Reserve lowering rates too quickly and inflation ultimately resurfacing. So, the best case scenario is rate cuts? We don't think so. Ideally, the Federal Reserve will be responsible and hold rates at this restricted level until the inflation is crushed, and to look at rate cuts possibly starting in 2024. If rate cuts are announced prematurely, the stock market will surge, reigniting inflation. You have to keep in mind that the target inflation rate is 2%, and we're not even close to that right now at 4.9%. At the same time, we have financial gurus like Meet Kevin having a pipe dream and calling the Federal Reserve will lower rates by a full basis point before the year end. What has the Fed said about rate cuts, though? Let's take a look.
We'll make our best assessment, and that's what we're thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation. We'd factor that in, but that's not our.
The lunacy of this Jim Cramer style investing and easy money has infected the mind of so many financial analysts these days. I don't know if it's because only bulls want to watch YouTube because shorting is hard and requires actual knowledge of the stock market other than green line go up. Yes, green line go up when you're in the biggest bull market in the last 100 years. But as our viewers know, it's time to become financially literate. The bulls and bears alike are going to be slaughtered, and we will emerge the wolves of Wall Street.